everybody. Today, we're going to be diving into some market stuff. Some interesting things happening right now. It's early 2025. And remember all that hype about the AI-driven bull market back in 2023? Everybody was expecting, like a smooth ride into 2025.
Yeah.
Especially with all the, all those predictions that the Fed was going to be cutting rates by the end of this year.
Yeah, the market seemed pretty sure the good times are just going to keep on rolling.
Exactly. But then, January hit. And things kind of took a little bit of a turn. Like on January 13th, all the major indexes dipped. The Dow's clinging to, I don't know, like some small gains. But the S&P 500 dropped almost a full percentage point, and the NASDAQ did even worse, like over 1.5%.
Oh.
So what's the deal? Why is the market, behaving so differently than everyone thought it would?
Well, it's pretty interesting, right? Because we're seeing these big banks publicly disagreeing on what's next for the economy, but more importantly, how the Fed's going to react to all this. Like, you've got Bank of America saying no rate cuts are happening.
Oh, wow.
And then you've got Citigroup predicting 5 rate cuts.
5.
And then Goldman Sachs is somewhere in between.
So it's like they're looking at the same information,
I know,
but coming up with totally different conclusions.
Totally. Like, their forecasts are totally different interpretations of where the economy is going.
Okay, so let's unpack this a little. It seems like there's this big disconnect between what the market wanted to happen and what's actually happening.
Absolutely. The market was definitely hoping for that soft landing everyone was talking about, where inflation cools down, the Fed cuts rates to kind of
keep things going,
keep things moving, and then good times keep rolling.
Right.
But the data, the economic data is showing a different story.
Really?
Like the December jobs report, that was way stronger than anyone was expecting.
Oh, wow.
It showed 256,000 new jobs.
That's great.
It's great for the job market.
But hold on, doesn't a strong job market usually mean inflation goes up?
Yeah, that's what people are worried about.
Okay.
A strong job market can make wages go up.
Right.
And then businesses raise prices, and we're seeing some signs that might be happening already.
Oh, no.
Like the University of Michigan's consumer survey shows people are actually expecting inflation to go up in the short term and the long term.
So the opposite of what we were all hoping for.
Exactly. And this makes things really tricky for the Federal Reserve. Nobody knows what they're going to do, and that's what's making the market nervous.
So it's like the market's looking at its dashboard and some warning lights are flashing.
Yeah. That's a great way to think about it.
Okay.
Even though the Dow is, still kind of holding on, there are other signs.
Like what?
That maybe things are going south. We're seeing what we call deteriorating market breadth, which basically means
I'm not sure I follow.
Fewer and fewer stocks are part of that upward movement.
So even if the whole market index is going up, it's really only a smaller group of stocks that are actually doing well.
Yeah, and we're also seeing more trading volume on days when the market is down. And historically, that's often
a sign of what?
A sign of bigger corrections to come.
Okay, so that's something to keep an eye on.
Yeah.
Are there any other signals flashing on this market dashboard?
Well, yeah, a couple of other important indicators.
Yeah.
The percentage of stocks trading above their 50-day moving average, that's plummeted from over 80% to under 45%.
Wow.
And then the advanced decline line, which basically tracks how many stocks are going up versus how many are going down, has really dropped.
So what you're saying is even if some of the big indexes are still up there, the underlying details are
pointing towards a potential change.
Yeah. Okay, I see.
Yeah. And we're also seeing this shift happening in terms of how different sectors are performing.
Okay.
Tech stocks, those were the big winners in 2023. They're starting to weaken. And at the same time, you've got these more defensive sectors like utilities.
Yeah.
They're gaining ground. And this kind of shift
That makes sense.
often happens when investors start to get a little bit more cautious.
Yeah, I see.
Yeah, it's like the market's starting to sweat a little,
Yeah.
And when that happens, it's a good time to listen to what the bond market's telling us.
Bond markets.
Yeah, because bonds usually pick up on those economic shifts way faster than stocks.
Bond whispers.
Yeah.
Okay, what are they whispering?
Well, okay, so the yield on the 10-year Treasury note, that's like the benchmark for interest rates.
Okay.
That's climbed back up over 4.8%.
Okay.
And, that's getting close to the levels that really spooked the market last year.
Gotcha. So why is that important? What does that mean about what's going on now?
Well, it means maybe the bond market doesn't really believe those rate cuts are coming.
The rate cuts everyone was so sure about.
Exactly. Like there's this tool called the CME Fed Watch tool.
Yeah, I've heard of that.
It basically keeps track of what the market thinks the Fed's going to do.
Right.
And the chance of multiple rate cuts this year tanked.
Oh, wow.
Yeah, the market's basically saying there's a good chance rates will still be above 4% at the end of 2025.
That is a big change from like a month ago when everyone was talking about the Fed cutting rates like right away.
Right. What's happening is the bond market is repricing risk. Like it's starting to think maybe inflation's not going to cool down like we thought it would.
Oh.
And maybe the Fed has to keep rates higher for longer to actually get inflation under control.
So it's not even just will rates go up or down, it's how fast they change and is the market ready for it?
You got it. And there are other things going on in the bond market that are kind of worrying, like the yield curve that compares short-term rates to long-term rates.
Okay.
That's starting to steepen again.
Okay, so what does that mean? I got to admit, I need a little refresher on bond market stuff.
Yeah, sure. So a steeper yield curve usually happens when the market's more worried about inflation in the long term, rather than like right now.
Gotcha.
We're also seeing something called corporate bond spreads starting to widen, especially in high yield bonds.
Okay, so you said spreads. What does that actually mean?
Okay, so think of it this way. A spread is the difference in yield between a corporate bond, like one issued by a company, and a U.S. Treasury bond, which are super safe.
Right.
So when spreads widen, it means investors want a bigger return to lend money to companies, especially the riskier ones.
So wider spreads in high-yield bonds means people are nervous about companies being able to actually pay back their debts.
Right. And that usually happens when interest rates go up and the economy is a little shaky.
Like a chain reaction. Higher rates make it cost more for companies to borrow money, and then everyone gets nervous.
Pretty much. And the thing is, this isn't just happening in the U.S., it's global.
Oh, right. What's going on around the world?
So the European Central Bank.
Yeah.
They're pushing back against rate cuts because inflation's stickier over there. And then the Bank of Japan, they're thinking about ditching their negative interest rate policy.
Okay, so how does that affect things over here?
Well, that could change how money flows around the world.
Gotcha. What about emerging markets? Don't they usually take a hit when U.S. rates go up?
Yeah, they do. And they're facing some tough times right now. A strong dollar and high U.S. rates are really bad for emerging markets, especially if they have a lot of debt in dollars. And we're already seeing investors getting cautious, like the J.P. Morgan Emerging Market Bond Index that tracks emerging market debt.
Right.
The spreads are widening, meaning investors want more reward for taking on the risk of lending to those countries.
So this goes way beyond just us.
Totally. It all goes back to how's the whole global economy going to adjust to higher rates? And, speaking of adjusting, what about all that AI hype?
Right. Wasn't AI supposed to solve all our problems and make everything grow forever?
Well, the long-term potential is still there. But the market's starting to look a little closer. Like, not every company claiming to be an AI company is actually going to be a winner.
So it's a reality check for the AI sector.
Exactly. The market's starting to figure out who actually has real AI advantages and who's just talking a big game.
It's like, show me the money. Show me the results, not just the promises.
That's it. This could actually be good in the long run.
How so?
Because it makes companies be honest about what their AI can actually do.
Like separating the wheat from the chaff. Now we're seeing who's got the goods and who was just all talk.
That's a good way to put it. And it all comes back to, what does this mean for investors? How do we make sense of all this?
The million-dollar question. Where do we even start looking for good investments in this new world of higher rates? Well, I guess the first thing is to figure out, which sectors actually do well when rates are higher. Where do we even start?
That's the key, right? So one way to think about it is look for the sectors that historically benefit from rising rates. Financials usually come to mind, especially banks.
Banks, huh? Why is that?
Well, think about it. Their profits are tied to interest rates. They make money on the difference between what they earn on loans and what they pay on deposits.
Right.
So when rates go up, that difference, their net interest margin, usually gets bigger.
So higher rates, more money for banks. But isn't it a little more complicated? What if the economy slows down and people can't pay back their loans?
You're absolutely right. We can't just buy any bank stock. We got to be smart about it.
So what should we be looking for?
Banks with strong balance sheets, good lending practices, and a mix of different loans. Banks that can handle some bumps in the road.
Gotcha. So quality over quantity. What about other sectors? Anything that's a bit more stable, especially with all this uncertainty?
Healthcare is usually a good bet. It tends to hold up pretty well even when the economy's not doing great.
Because people always need healthcare no matter what's happening.
Exactly. And what's really interesting about healthcare right now is all the new technology. Telehealth, AI diagnostics, personalized medicine, all that stuff.
Yeah, that's pretty cool.
It's got the potential to really change things and make healthcare more efficient, which could lead to growth.
So healthcare's got stability and potential growth. It's a good combo. Anything else we should be thinking about?
Energy might be worth a look. It's been kind of quiet lately.
Yeah.
But there are some things that could give it a boost.
Like what?
Well, you've got geopolitical stuff happening around the world, which can mess with supply and make prices jump.
Right.
Plus, there hasn't been a lot of investment in oil and gas infrastructure lately.
Really?
Yeah, and that, combined with growing global demand, could mean higher energy prices.
So even though everyone's talking about renewables, fossil fuels are still going to be around for a while.
Yeah, the transition's going to take time. So traditional energy companies could do well. A lot of them are making good money right now, and their stock prices are looking pretty attractive. So investors looking for value might be interested.
Makes sense. Okay, so we've talked about financials, healthcare, and energy. But what about tech?
Ah, tech. The big question, right?
I mean, it was the star for so long. What happens to tech stocks now that rates are going up?
Well, higher rates tend to hit growth stocks harder, and tech companies are basically the definition of growth stocks.
Why is that? Why are growth stocks so sensitive to interest rates?
Because their value is more about future growth, not current earnings. So when rates go up, those future earnings are worth less today.
I see.
It's like the discount on those future earnings gets bigger.
So even if a tech company is doing well, its stock price could still go down because of higher rates.
Exactly. And since growth companies often put a lot of money back into the business, they can be hurt by higher borrowing costs. That can slow down their growth.
So does that mean we should just avoid tech stocks?
Not necessarily. It just means we need to be picky. Look for tech companies that are already making money, have strong cash flow, and can raise prices without losing customers.
Companies that are the real deal, not just hype.
Exactly. We want the ones that can handle whatever comes their way.
Got it. So it's all about quality and fundamentals no matter what the market's doing. So we've talked about sectors, but what about our overall strategy? What do we need to change as we head into this higher for longer world?
Well, one thing to think about is your bond portfolio. With rates probably staying high for a while, it might be a good idea to shorten the duration of your bond holdings.
Duration. Remind me what that means again.
Sure. It's a measure of how sensitive a bond is to interest rate changes.
Okay.
The longer the duration, the more the price drops when rates go up.
So if rates keep going up,
you want shorter duration bonds to protect yourself.
Makes sense. What about stocks?
With stocks, you want to focus even more on quality and valuation. Look for companies that have strong balance sheets, are consistently growing their earnings, and have reasonable stock prices compared to their earnings and cash flow. Companies that are built to last no matter what's happening in the economy.
So a more defensive approach, focusing on quality and value. And we should keep in mind those sectors we talked about. Diversifying across sectors that could benefit from higher rates while being more selective within sectors that might struggle.
Exactly. It's all about being flexible and adjusting your strategy as things change. And probably the most important thing is having a good risk management plan.
What do you mean by that?
Having a clear plan for how you'll handle your portfolio in different situations. When things are uncertain like they are now, you need to know how much risk you're comfortable with and have strategies to minimize potential losses.
So it's not just picking the right investments. It's having a good overall plan, understanding your risk tolerance, and being ready for anything.
Exactly. Now, to help us figure this all out, let's think about some possible scenarios. Let's start with what we'll call the base case scenario. We'll say there's a 60% chance of this happening.
Okay, so what's the base case?
In this scenario, the Fed doesn't cut rates as much as the market expects. That means things will stay volatile, but we probably won't see a huge market crash. Company earnings will grow a little, which is enough to support current stock prices, even with higher rates.
So a bumpy ride, but not a disaster.
Right. Now, let's say there's a 25% chance of a more optimistic scenario.
Okay.
In this one, inflation keeps cooling down, and the Fed can actually do what the market wants. This would be good news for both stocks and bonds, especially growth stocks.
So this is the soft landing everyone was hoping for.
Exactly. And finally, there's the risk case scenario. We'll say there's a 15% chance of this.
Oh,
In this scenario, inflation is stubborn and doesn't go down as much as we'd like, so the Fed has to keep rates high for a long time.
It doesn't sound good.
No, it doesn't. This could cause a big drop in the market, especially for those expensive stocks that are really sensitive to interest rates. It's not the most likely scenario, but we need to be ready for it.
So how do we keep track of all this? What should we be watching to see which way things are going?
There are a few key indicators. First, the monthly PCE inflation data, especially the core services part. This is what the Fed looks at, so it's important for understanding if their policies are working.
Okay, what else?
Keep an eye on the labor market, things like wage growth and how many people are working or looking for work.
Yeah.
If the job market stays strong, wages could go up, which could lead to more inflation.
Gotcha.
We also want to track how much profit companies are making and how much their revenue is growing. These are good signs of how healthy businesses are. If companies start struggling, it could be bad news for the stock market.
Makes sense.
Anything else? Watch the credit markets, specifically the spreads, and how easily money is flowing. These can give us early warnings about problems in the financial system. And finally, pay attention to what other central banks around the world are doing. Their decisions can have a big impact on our markets.
So if everyone's raising rates at the same time, it could slow down the global economy, which would affect us too.
Exactly. It's a lot to keep track of, but by staying informed and being flexible, we can navigate these tricky times and hopefully come out on top.
Wow. That is a lot to think about. Sounds like it would be really helpful to have a group of people to talk to about all this, other investors who are following this stuff closely.
Absolutely. Having a community where you can share ideas and learn from each other can make a huge difference, especially in a market like this.
For sure. Well, we've covered a lot of ground today. Any final thoughts for our listeners before we wrap up?
Just remember that the financial world is always changing. The more you understand about what's driving those changes, the better decisions you'll make. Stay curious, keep learning, and don't be afraid to change your strategies as the market evolves.
Great advice. Thanks for joining me on this deep dive. Until next time.